Hey all, in this video, we're starting Unit 4, and so we're going to be looking at banking. And so banking is typically a concept that a lot of students don't really understand the first time, so I would pay close attention to this video and do as many practice problems as you can. What do the two walls say to each other? I'll meet you at the corner. Let's get started. So banking. And so when we're talking about banking, we're really going to be referring to the fractional reserve banking system. And so what fractional reserve banking is that whenever you deposit money into the banks have to hold on to a portion of those deposits because it's required by law. The reason why they have to sort of set aside a small percentage of the money that you deposit is to cover other potential withdrawals. But at the same time, they don't need to hold on to the entire amount that you deposited. They only have to hold on to a portion of it. And so the rest of the money that they aren't legally required to hold on to, what banks are going to do is loan the rest of the money out, and in that way create more money. For example, right? Let's say you have $100. You deposit $100 into the bank. Let's say by law they have to hold on to 10% of it. That means that the bank needs to hold on to $10, and then they can do whatever they want to with the rest of that $90. And so that $90, what they're going to do is they're just going to loan it out. And banks are going to continuously do that. And that's the fractional reserve system. And so here, before we move on to the actual what this video actually entails, there are some key terms that you have to know. The first is a demand deposit. So for all intents and purposes, a demand deposit, just think of it like your checking account, right? And so what a demand deposit is just the money deposited in a commercial bank. So in other words, right, whatever money you put into your checking account, right, is going into the bank's demand deposits. And it's a liability, right, because it's what the bank owes you. If you put $100 into the bank then owes you $100. Well, what we talked about in the last slide, fractional reserve banking, then if you put in $100 into the bank is required to hold on to a small portion of that deposit. That is known as the required reserve. So the required reserve is the percentage that the banks have to hold on to by law, right? So whatever money deposited into the demand deposit, into your checking account, the required reserve is what the bank needs to hold on to. So let's say you deposit $1,000, right? And then our required reserves is 20%. Well, that means, right, the bank has to hold on to $200. Well, here, where does the other $800 go? Well, the other $800 then goes into something known as the excess reserves. And the excess reserves is the money that the bank can do whatever they want with, right? More than likely, they're going to loan it out to other individuals, to other customers here. And then all this added together is a balance sheet. And so a balance sheet, you're also going to see the term T account. So T account, balance sheet, they're all the same thing. And what a balance sheet tells us, right, is it tells us the bank's assets, the bank's liability, as well as the net worth of the bank itself. And so what does a balance sheet actually look like? Well, this is what the balance sheet actually looks like here, right? We have our assets on the left-hand column. We have our liabilities on the right-hand side. And so notice, right, that at the end of the day, the total assets and the total liabilities are equal to one another, right? And the reason for that is because it's a bank balance sheet. We're going to say it's a balance sheet because the total assets have to equal total liabilities at the end of the day. And so let's take a look at this bolded question at the bottom of your screen. If the bank is holding on to no excess reserves, how much is the required ratio? In other words, how much does the bank legally need to hold on to, right, by law? Well, we know our reserves right here, and we know that our reserves is made up of our required reserves as well as our excess reserves. And so we know that the total reserves right now is $500. We also know, right, that there has been $5,000 worth of deposits into this bank. So how much does the bank legally need to hold on to? What is the percentage here? Well, here, this question gives us an important piece of information. There is no excess reserves, meaning, right, that this $500 is all required reserves here. So to figure out our required ratio, we're just going to take our required reserves, right, divided by our demand deposits. So here, what we're going to do is just take the 500 required reserves divided by $5,000, just to 0.1 or 10%. Meaning, right, whatever new deposit coming into the bank legally has to hold on to 10% of that. And so we talked about with the fractional reserve banking, right, that banks make money by loaning out the money, right? They create money out of thin air. And so in this example, right, we are going to say the reserve ratio is 10%, meaning whatever is deposited into the demand deposit / checking account, the bank is legally required to hold on to 10% of that. So let's say, right, that you deposit $1,000 into the bank. Well, 10% of 1,000 is $100. So that is why the bank has to hold on to $100 in their required reserves, which means that $900 then goes into the bank's excess reserves. Theoretically, what is the bank going to do? Well, the bank then can just loan it out. So let's say the bank lends out the entirety of that $900 to George. And let's say then George deposits $900 in the bank. Well, here, right, if it's $900, the bank, because of the 10% reserve requirement, has to hold on to $90, and that goes in the required reserves. But there's $810 left, which then goes into the excess reserves for George's bank. Well, let's say, right, that this bank decides to loan out the entirety of that $810 to Jules. And let's say Jules then goes around and deposits $810 into her bank. So if you notice here, right, you initially deposited, right, $1,000. But it actually created an additional $1,710, right? We take the $900 that George now has that he deposited into his checking account, and then we add, right, the $810 that Jules took out and deposited into her checking account, right? And together, right, that gives us our $1,710. And so this concept is known as the money multiplier. What the money multiplier tells us is it tells us what is the maximum change in our money supply. Or in other words, what is the maximum amount of money that this bank is theoretically creating. And so how we get there, right, is we just do 1 over our reserve requirement. So if our reserve requirement is 10%, right, we're just going to do 1 over 10, so our money multiplier is 10. If our reserve requirement, let's say, is 50%, we're going to do 1 over 2, which then our money multiplier is 2. All right, so let's do a little bit of practice with this. So I broke up an FRQ. What I want you guys to do is just pause the video real quick, solve parts A, B, C, D, and E, and then we'll go over each one together. All right, so if you could pause the video now, try to do parts A through E, and then we'll go over it. All right, so let's do parts A and B first. So what's important to us? Well, we have our assets on the left-hand side and liabilities on our right-hand side. We know that the reserve requirement is 20%. We know, right, that there are reserves, but we don't know what is the required reserves. We also don't know what is the excess. We just know that this $30,000 is just our total reserves. So part A, calculate the dollar value of the reserves that the Bank of China is required to hold. In other words, what this question is asking is, what is our required reserves? So out of that $30,000, right, that's in our total reserves, how much of that does the bank need to hold on to? Well, to get there, we have to look at our demand deposit, right? If there is $100,000 in this bank, right, in people's checking accounts that this bank has in their demand deposits, right, and that the reserve requirement is 20%, because the bank needs to hold on to 20% of all the demand deposits, we know that our required reserves is $20,000, right? Or in other words, $100,000 in the demand deposits times 20% gets us to $20,000. So out of this $30,000, right, the bank is required to hold on to $20,000 of it, which means, right, that our excess reserves is $10,000, right? Because just our required plus our excess should get us to our total reserves there. Well, that's what Part B is asking, right? Part B is asking, given the current reserves, what is the maximum value of additional loans the Bank of China can now make? We don't look at the $70,000 in loans because that $70,000 represents the loans that were already being given out. And remember, what the bank loans out can be entirely found in our excess reserves. So if there's $30,000 in total reserves and $20,000 of those dollars the bank needs to hold on to because of the required reserves, Uchenna, the Bank of Uchenna, can make an additional $10,000. Or in other words, the $10,000 found in the bank's excess reserves. Part C. So we have LEK. She raises $5,000 in cash from a yard sale, deposits the cash in his checking account. So how much money, or how much does the money supply change as a result of LEK's deposit? Well, we're going to say there is no change in the money supply. Why? Well, remember, right? There's different classifications of money. And so if we go from cash to a checking account, that's going from M1 to M1 money, right? The classification of money there doesn't change. Remember, M1 money is liquid money, or stuff that can be easily spent right here and now. So you can easily spend cash, and you can easily spend money in your checking account through a debit card. And so because we go from M1 to M1, there is no change in the money supply there. All right, let's go to Part D. Calculate the maximum change in demand deposits as a result from LEK's deposit. Well, we know, right, LEK deposited $5,000. We want to figure out what is the maximum change in demand deposits then. Well, here, this is where we use our money multiplier. Remember, our money multiplier equals 1 over the reserve ratio. And we know that the required reserve ratio is 20%, so we do 1 over 20%, which should get us to 5. So now we take the $5,000, right, that LEK deposited, multiply that by 5, and so in theory, right, the maximum change in the demand deposit in the banking system is going to be $25,000. In other words, what LEK deposited times the money multiplier. All right, so Part E, let's say that the Bank of China doesn't have enough money to satisfy that 20%. In other words, they're not holding on to 20% of all the demand deposits in their required reserves. What can the Bank of China do? One, they can either just borrow from other banks. Borrow from other banks, right? Or number two, they can just borrow from the Federal Reserve or the central bank, right? And so that's the answer to Part E. Well, that's all I have for you guys. I hope you guys learned a lot, and I'll catch you guys in the next video. Peace.